Global inflation and global interest rates at all-time lows, especially in the developed world. Foreign investors are still finding value in the local bond market. Ian Scott, bonds dealer at Stanlib, joins us in studio to chat about fixed income. And perhaps let's just start there, Ian. Thanks so much for joining us in studio, and Warren as well. Are we going to see continued appetite for our bonds from foreigners?
Bronwyn, yes. We think as a house, this is not a once-off story. We think there's been a fundamental shift in developed markets that because there's no yield in the world. If you actually think about US rates are close to zero, European rates are close to 1. Our rates are probably close to 7 to 8% on the yield curve. And we think there's a fundamental shift, because what do? You can't set at 1. And inflation in developed markets is probably around 2%, so you're already negative. So you come to emerging markets like South Africa, where the yield is 7 to 8% on the yield curve, and inflation is 2, so you've probably got about a 5-6% real yield. And that's very attractive.
Okay, and just in terms of, we know that foreigners owned a lot of bonds, and then we saw the sell-off earlier this year. I mean, when we talk about the local bond market, how much of those bonds are actually held by foreigners? Do you have an idea as to, you know, what that share is?
If we just look at the JSE stats, this year to date they've bought about 59 billion. The holding at the moment for the foreigners has risen dramatically. It's about 30% of our bond market at the moment. So, you know, they were very small holders for the last few years. And I'd probably say in the latter part of 2011 and obviously in 2012, they're massive buyers of South African bonds, and they're huge drivers of lower yields in the market.
Talk to me about duration. Now, it's 5.9 years on the 10-year government bond in South Africa. That's got its own merits, hasn't it?
It does. It's one of the longest bond indices in the world. If you look at bond indices, they're probably around 4.5. It's all to do with government and doing switch auctions, because government's redemption profile is very stacked in this, let's call it 2013 to 2017 era of the yield curve. And they're trying to push it out in this, call it 2023 up to 2036, 2041 area of the yield curve. So that's why our bond yields are going lower, but the duration is being pushed out further into the probably closer to 6.
So this is just in terms of that duration, it's actually being engineered by National Treasury that way. And one of the things I heard in the market was that it was being done so that there's no great reliance to refinance in the next 2 years, partly because of the economic situation that the world finds itself in. What's your thoughts on that? Is it more just to spread out the way the government's maturing these bonds, or is there an angle there that it might be done to try and avoid having to refinance in a very negative market, especially when you see what's going on in Europe?
I think it's a function of both. Government doesn't want to be lumped with this huge refinancing risk coming in 2013 or 2014. I mean, that was one of the major problems happening in Greece, that your funding requirement is just too large. And secondly, government obviously wants to stretch the cash flow profile as well. So you want to push it out. You don't want to sit with a too onerous situation every year saying, well, we've got to find X billion of rands in the market. We rather push it out further. But it's a global phenomenon. We see it globally that governments want to try and push their durations out and push their yield curves out.
Okay.
Definitely.
Okay.
Go ahead, Warren.
Just to follow up. So I mean, it's basically inverting what the Americans are doing, where they're trying to buy. Issue short-term paper in Operation Twist, as we saw Ben Bernanke testify yesterday. Issue lots of short-term paper and buy lots of long-term paper in the market, so that you compress the yield at the 10-year level. We're actually doing the opposite. We're trying to finance over longer maturities, so that we don't have the pressure to finance in the short term like perhaps some of the European countries, although we're not in such a bad situation as some of the European countries.
That's true, Warren, but remember the US had a banking crisis, and it's trying to support the banking system. South Africa never had the banking crisis. So what government just says, well, we want longer term maturities on our bonds and our debt profile, where the Americans are actually trying to restart the housing market, if you actually think about it. Remember in the US, the whole housing market is linked to the 30-year bond rate. If that bond rate goes above 4%, it's very negative for the US housing market. So what does the Fed say? Well, I'll issue you shorter dated bonds, and I'll go and buy the longer dated bonds, keep the yields down, so it makes it more affordable for the man in the street in the US to afford those 30-year loans.
And of course, inflation is trending downwards. That favors the bond environment. We're sitting with CPI coming out today at 5.5%. I see your house view was at 5.6%, so slightly below that. Do you think we're going to continue to see this trend lower on inflation?
Bronwyn, definitely. I think it's a global story. Inflation is trending down. What is the big drivers? Well, we've seen the oil price come back a lot. The rand's fairly stable in a range, and we see food prices retreat as well. So we think that the trend for inflation could be down. And what we've seen in the past in the bond market as well, that inflation could actually surprise us on the downside. That you might get a number that's very close to 5 by the end of this year, or close to 2013. Let's say all things being equal. So it's very good for the bond market what's happening to inflation globally.
So does that mean that are you seeing the bond market pricing in a rate cut in the next 12 months?
Yes, definitely. I think the bond market has already priced probably another 50 basis points of rate cuts. Not necessarily tomorrow. It might be a little bit soon, but definitely between the September and November meeting, I think we could have a 50 basis point rate cut, definitely.
Just throwing a curveball in there, with this downward trend in inflation, would we see deflation on the horizon? Is it something you discuss, or is that so far off that it's kind of, I shouldn't even be mentioning it on the desk?
Deflation might be a swear word to central bankers, because what do they want? They all want inflation, they want growth. I think it's very dangerous to predict deflation. We don't think so. We think there's a definitely strong disinflationary environment at the moment, but deflation is a Japanese-style deflation. It's hard to say at the moment. But you never know, but I wouldn't say that's our base case or our view. It's a very far out view at the moment to have proper deflation Japanese style.
Can you weigh up corporate bond environment versus the South African, the government bond environment and the corporate bond environment? Which would you favour at the moment in South Africa?
Well, at the moment, we do like the corporate bond market. If you just look at the issuance, government issues probably about 88% of the bond market at the moment, so they're really crowding out the corporate market. The big issue in the corporate market is because we all know that they've got lazy balance sheets. There's 530 billion sitting on corporate balance sheets, so it's very lazy. They're not really coming to the bond market to say we want to borrow money to come and build that factory or whatever corporates need to do. What we've actually seen is that corporates are net investors of funds, in our various funds. So at the moment, they're not big borrowers in the market, but we do like the corporate bond market.
Right, okay. Just on the question of corporate bond and rating some of these bonds, Ian, where do we stand with the credit rating agencies at this point? Have they recovered from the tremendous knock?
The reputational damage. Don't be shy on knocking the rating agencies. We've been all over them on this news days.
I'm probably the wrong person to ask. I'm not a big fan of the rating agencies, because I think they stuffed it up, if you really want to call it, and now they're just trying to make up name. Luckily for us, we've seen that pension fund and collective investment scheme legislation move away from ratings. If you think about Reg 28, we don't live in a ratings world anymore. I think we all have to get a lot smarter, basically do our own in-house ratings, if you really want to call it. We're not as reliant on rating agencies anymore, and we're not going to be, because I think they've dug their own grave in my mind for the future. We can actually go and do our own work.
What about the efficiency of the bond market and trading in itself? That also has been a big question. Obviously, that arena being integrated into the JSE. Is everything working well? There have been those out there, like the Andrew Cantors of the world, that long maintain that the bond market in South Africa is somewhat constipated. I'm using Andrew's terminology here.
He's more than entitled to his view. We think the bond market is working fairly efficiently. We've got the primary dealer system. We think it works well. There's never going to be a perfect system, but I think what we have at the moment is a fairly decent system in terms of the bond market. Turnover on average about 23 billion rand a day, which is very good. We've got about 10 primary dealers out there making markets. It works. I think that's also one of the reasons why the foreigners do like the South African bond market, is because there's liquidity. There is liquidity in the South African bond market.
Well, that makes sense.
I don't necessarily always agree with Andrew, but he's entitled to his view. We think it works because the other question that I would ask him is, well, if this system doesn't work, none of us have figured out what is better. So show me what is better and I'll listen.
You know what? I'm going to ask him the next time I have him on this show, and I'm going to make him come out with an answer.
Just on that, obviously the push by the JSE was to get it onto exchange trading. I've become familiar with the system of interdealer brokers and the primary brokers, but at one point I understood that there were more South African government bonds being traded in London amongst bond dealers there than there were in South Africa. So is there an argument to push these things onto exchange, or do you think that the price discovery is good enough as it is, using this system of almost a hybrid system of dealers between the bonds?
Our team's view at Stanlib was always that we'd like to keep the primary dealer system for government bonds and maybe parastatal bonds, but for corporate bonds, because the corporate bond market is not as liquid as the government bond market, obviously. And maybe that's a way to start. So you just start crawling before you start running. Is well, let's start with the corporate bond market and push that onto the central order book system and see how it works. And then if it works, then you're free to go and make a price. But don't just shut off the primary dealer system and then say, well, go to the central order book. I think it has to be done in steps. There's a place for both. I think we just have to manage it.